Hello, good morning, everyone. Hope everyone is doing well. Welcome, YouTube. Welcome, traders. It is uh, January 5th, Wednesday. We are in our. Is it Wednesday? No, Thursday. We're January 5th, Thursday. We're in our third trading day for the year. I hope everyone's doing well. We're going to be discussing a few things here today. We're going to be talking about the We're going to be talking about job layoffs in tech. We're going to be talking about the FOMC that came up yesterday. We're going to be talking about some levels, some ideas to give you guys kind of a breakdown, kind of a plan to start the day with in the S&P 500 futures market. And why don't we get started? Here we had a trade actually pre-market in our room. I hope everyone was looking at it, paying attention to it, yada yada yada. It's quite the mover right now. So I wanna break this down for you guys, starting off with some of the tech layoffs because this is a big part. This is a big part of the macro scale of things. This is what we talked about on the first day of the year, and understanding that peaking of a job market and layoffs and job turnovers and all that good stuff, all that bad stuff, is necessarily coming into the peaking point of the whole economic cycle and also the market cycle, which remains into the downtrend. And I think there's going to be a little more of that. So tech layoffs, right, amidst a industry-wide layoff cycle, right, based on these macro headwinds. The first wave, excuse me, my bad, came in the middle of last year, and those numbers are only just growing in strength. Realistically, many companies also hired very aggressively throughout the pandemic. There are still some companies that are continuously hiring with banks, even though they have started layoffs in capital markets, investment banking, stuff like that. So um, they are realizing that inflated payrolls and elevated costs are not going to hold up in this business environment. And the latest was Salesforce CRM that cut 10% of its workforce and is closing some offices, leading to about 1.4 to 2.1 billion in charges for the company and laying off around 8,000 workers. Amazon also cutting its headcount by over double that figure, about 17,000, I believe the number was. And the retail behemoth confirmed that about 17, 18,000 employees will get snipped, with the bulk of those roles due to elimination concentrated in the firm's e-commerce and human resource organization. So the environment remains challenging for our customers, and they're taking a more measured approach to their purchase decision. This is what CRM Salesforce Mac Bainoff said in a letter to employees. Amazon has weathered uncertain and difficult economies in the past and will continue to do so, said Andy Jassy. And these changes will help us pursue our long-term opportunities with stronger cost structure. However, I'm also optimistic that we'll be innovative, resourceful, and scrappy in the time when we are not hiring expansively and eliminating some roles. Realistically, there's a tracking website for this, layoffs.fyi. More than 150,000 tech workers were fired in 2022. That's a pretty large number. You compare that to the added jobs numbers, realistically, it's very, very close. We have NFP tomorrow. That's going to be a huge thing. And the number is poised to grow this year, right? Realistically, I would say, I don't know. I'd say at least over 200,000 in this year because they started, remember, last year midway. I think midway through this year, we get some kind of turnaround. Companies in the industry that have shed employees are naturally Airbnb, Booking Holdings, Carvana, Cisco, Groupon, HP, Lyft, Meta, Netflix, Peloton, Twitter, Uber, and Zylo. Now, what do all these companies have in common? Realistically, they have been struggling with these scales and with the last year and the massive downside that overvaluated their stocks and their companies realistically. So now things are starting to take a turn. Now that we have Amazon and other large companies like Google talking, Apple, right, layoffs coming into those, and especially when they come into banks, we are going to see a massive shock realistically in the jobs market and probably in the market itself. So yesterday, a big, well, I'd say the biggest news of that day, not a very, very massive event, but we had the Fed meeting minutes, and naturally, the persistently tight labor market is playing into the Fed's decision to continue raising rates, but a smaller increment, naturally, according to the Fed meeting minutes. December based on the meeting minutes compared to December 13th to 14th. Last month, the Fed policymakers arm increased its key rate by 50 basis points to 4.25, 4.5, which we talked about, a smaller increase in the 75 basis point hike that was implemented in the previous few meetings. And officials also raised inflation expectations at their last gathering with a median PCE inflation projection at 3.1% at the end of this year, up from September's projection of 2.8%. So we'll see how that happens. But realistically, there's no real signs of the Fed pivot, as we talked about time and time again. They don't want to do it too early. The Fed officials agreed that the inflation remained unacceptably high and remains a risk to the upside. So while October and November data were welcome reductions in the monthly pace of price increases, it would take a substantial more amount of evidence of progress to be confident that the inflation was on a sustained downward path. The pace of increases in prices of core services, excluding shelter, was also notable, while the factor is likely to remain persistent and elevated if the labor markets remain very tight, which naturally they are expected to do so. Participants generally noted that the uncertainty associated with their economic outlooks was high and the risk of the inflation outlook remained tilted to the upside. So according to these minutes, they named such uncertainties as China relaxing zero COVID policies, Russia's war against Ukraine, the effects of many major central banks firming policies at the same time, and stocks gave up a lot of those gains based on that news and closed the session relatively balanced, right? Very volatile whipsaws yesterday. And realistically, we have the NFP report that is coming out tomorrow. So shockingly enough, I do expect to see us come back into a balance today and kind of exit that balance that we've seen so far over the last few weeks, I should say, tomorrow based on the NFP. So with risks of to inflation remaining very elevated, no participants expected that it would be appropriate to reduce the federal funds rate target in 2023, right now 5.1%. And that uncertainty also means that the Fed will have to be flexible when moving policy to a more restrictive stance. So there was also discussion about balancing the risk of not tightening enough, which would lead to surging inflation expectations, as well as the lagged cumulative effect of continuous policy tightening, which could lead to unnecessary cuts in economic activity, which already have started. So with all that being blabbed and said, realistically, we should take a gander at what the hell is going on with these levels in this market, because we fell off of a very, very, very important level, 3883 to 3885 this morning, dropping into the 45 region, that 47, let's say 47 region, which is another key area. That area, 45%, whatever, that area, I'm expecting to see a little hold here, come back into that balance. That is a huge area. I think balance will want to sustain, maybe come back and test that 57. That's an area that I'm going to watch very, very carefully, the 57s. And realistically, I would anticipate maybe we try that 36, 38 again. That's an area that I would not be upset about trying to fade, aka buy maybe a few little contracts, something smaller risk, see if we can get that pop back into balance. I don't really want it to accept too much under that balance if we're going to sustain throughout the day. Otherwise, I'll probably be targeting 38, like 16 or so realistically. I think the 57s are kind of an intermediate level, but they're a very, very strong ledge on a distribution block. Watch the 69s and the 83s and the 76s today. I know there's a lot of levels. There are a lot of levels, but the main two levels that I'm watching for are 45 to 47, see if buyers come in. If they don't, 36 to 38, and that's where I'm going to kind of start the day and then see how things progress from there. But so far, the downside here pre-market kind of sustaining back into the lower edge of balance from yesterday. So I'm going to see how that shapes up throughout the day. Starting off the day on a sell side here pre-market, I anticipate some buyers do try the morning session, and we'll kind of see probably taper off in volume into the end of the day in anticipation of NFP tomorrow pre-market that we're going to take a look at with the team. So I hope everyone enjoyed that. I hope everyone has a great day, great trading day. We'll be back tomorrow with another update to wrap up the short week, and I'll see you guys then. So thank you, take care, and chat soon.